Hello again, everybody. Time for some lovely questions, in which case I'm going to do some calculations for you on some ratios. So I'm going to share my screen again with you. Pardon the short delay in the initial setup, as always, but it shouldn't take too long. Right, so here I have a question in which I'm going to try to cover all of the ratios except for the investment ratios. Those will be done in a separate recording. So in your own time, you can read the introduction, but what we are wanting to do is we're going to calculate many ratios for a period of time, and always important to look to see what period of time we're talking about. So the statements are at the end of February 2023. So you're going to see that there's a comprehensive balance sheet and figures are provided for 2 years. You'll soon see why I've given you the values for 2022 as well. Yeah. Then further down, we have the income statement at the same point in time, starting with sales. It's quite abbreviated, the income statement, and it wraps up with the net profit for the year. Then always pay attention to any additional information or notes that are provided. You will not be able to get going with the question unless you pay particular close attention to what is here. I think you can always expect to have some additional information in a question. Right. Then we need to calculate ratios ended when? 28 Feb 2023. Right, so ratios are able to analyze the financial statements, give financial management information on which to base decisions. It can also help the public who are wanting to invest in companies. So there are many things that you want to know about a business. Is it solvent? Is it profitable? Is it liquid? How efficiently is it managing its assets? How much debt does it have compared to equity? Because that's an exposure to risk. Risk also affects expected return and so on. And then there are, of course, the investment or the market ratios. So this question, I'm going to deal with all of them except the investment ratios. So I'm going to add one in at the bottom over here. Let's just type it in because it is possible to do this one as well. So we're going to also include the debt equity ratio. Over there, let's just move it so that it lines up there. So let's start with the solvency ratio. This one is looking to see how many assets there are compared to liabilities. So we must look at total assets and total liabilities. So that means that we've got to look at the balance sheet because that's the correct statement. Income statement won't help. So let's have a look here. The total assets as at February 23 are this 1.647 million. Now, I need to tell you to be careful here. If we now go and compare it to that number at the bottom, we are making a silly mistake, which tells your lecturer that you do not know how to read a balance sheet. So if you were to do that calculation, you would always only get 1:1. Now, the problem that you have encountered over there is the following. Total assets, remember the accounting principle, must equal what? The sum of total liabilities and what? Equity. So there's two things here. What do we need? Only the liabilities, not the equity. So how are you going to overcome this? Two things. You could either subtract the equity from the 1.647 million. I think, maybe prone to a bit of a mistake there. So what would be better? Simply to take your non-current liabilities, which is the mortgage loan, and add all of your current liabilities together. And then equate that to the total assets at the top. So let's do that. Right. So how do you get good marks in your test? You need to write down the formula, because marks are given for the formula. You can see there, I've got little ones above some of the numbers. That's an indication as to where the marks would be allocated. Okay. So our total assets divided by our non-current liabilities plus the current liabilities. Don't skip steps. So make sure that you actually include this step. Now, why do I say that? Because method marks are awarded in this subject. But we cannot help you with method marks if there's nothing to read on the page. So in case you do make a mathematical mistake or a calculation mistake, you can still pick up the majority of the marks for it, but your workings must be shown. So what do we see over here? Our total assets exceed the total liabilities by quite a lot. So our ratio is 4,71 is to 1. And now the important thing about this is, how do we express the answer? It must be in the form of a ratio. So that's why I must write 4,71 is to 1. And we will take the convention of rounding to 2 decimals unless the question indicates otherwise. So you must therefore say 4,71 is to 1. Otherwise, it's not a ratio. Now we're going to move on to the profitability ratios, and there's 3 of them: gross profit percent, net profit percent, and return on average owner's equity. So to find this, we need to look at the income statement. So the formula is your gross profit as a percentage of your total sales. So what are the numbers that we are looking for? Let's just get a slightly different color over here. Our gross profit, there's the number. Our sales, and remember this is total sales, up there. Divide the one by the other. All profitability ratios must be a percent. That's why we must times by 100. So let's see. There's the formula. Get a mark for that. Substitute in the 2 values. Get a percent, and we're going to get 37,61%. Okay. That one is straightforward, because you would just take the correct numbers off the income statement. But what you also need to remember is some of your very basic accounting. Don't go and forget that. And what do I mean over there? How do you work out gross profit if you don't have it? Don't forget that it's going to be your sales subtract your cost of sales. That's one way to work out GP if it's not there. Okay. Another thing that you could do is you need to remember the layout of the income statement. Normally we start at the top with sales, and then we get gross profit, and then we get gross operating income, then we get gross operating profits, and then we do various things, adding in incomes of some kind, minusing expenses of some kind, and eventually then we're going to land up at the bottom here with our net profit. So what I'm saying here is possibly remember that, because instead of doing the usual, which is starting at the top and working to the net profit, what happens if you are given the net profit and something, for example, in the middle, let's just type in something. Let's say we need gross profit. And we can't find it if it's not, let's say it's not on the income statement. If we can't go the sales less the cost of sales route, what could you then possibly do? You just need to remember that you could start with net profit if you had that, and you could work your way up that way. So anything that you would normally have subtracted, you'd now add. Anything that you added, you would now subtract. So that would be a possible situation. But in this question, no need because the numbers were there. Then net profit percent. Very simple. What percentage of sales is your net profit? So once again, we are back to the income statement. So here is our net profit calculated for us. And we're going to put that as a percentage of the sales number at the top. Don't forget, must be a percentage. So let's look at the workings there. That gives me 19.29%. So what you'll notice here is that the gross profit is nearly 38% and the net profit is only 19%. So what could account for the big drop? So if you understand the income statement, that will help you. Because what could you also be asked besides the calculations in your test? You may have to very briefly do the following. You may need to comment on a ratio, maybe interpret it, or maybe give possible causes of it and identify a trend. So what do I mean by trend? Whether a ratio has improved over the period or whether it has worsened. In this case, no. I've just asked you to calculate for a single period. But if you were to indicate if the ratio got better or worse, they would ask you to calculate the ratio for more than 1 year. Or in the question, they could put it in a bracket. So for example, here, like let's just say there, we are working for 2023. And let's say in this bracket over here, we're going to say 2022. Remember, of course, you could work these out because we do have financial statements for both years. But I'm just now purely making up a number. Let's say that it was 15%. So then we could identify a trend. So what have we got for this year? 19%. So there's been an improvement in the ratio. And then it becomes more profitable. And then you could try to give some reasons why. So you could, for example, have a look and see, did the gross profit improve over the period? Did your operating expenses get less over the period? Did any of your other incomes or your interest income go up? Did your interest expense go down? That kind of thing. Okay. But only do that if you are instructed. Then the third of the profitability ratios is the return on your average owner's equity. So as you know, the owner contributes capital, the business operates, hopefully it earns a profit, and that is the return to the owner. So what is very important here in this ratio is the use of this word average. So whenever there's one that has the word average, and there's a few of them, that means that you need to do what? Let me just type up here for you. We are going to take the current value I just forgot to open a bracket. The current value. And then what we're going to do, we are going to add the previous value from the year before. And we're going to close the bracket. And then finally, to find the average, we're going to divide by 2. Let me just move that so you can see it there. There. So the current plus the previous value, in this case of owner's equity, divide by 2. So let's take that same net profit that we had above, but I'm going to show you where I got my values for the equity from. Have a look here. It obviously must be balance sheet. So I'm going to highlight them for you. So for the 1 year, there's the number. And for the other year, there is the number. So we're going to take the two, add them together, divide by 2, and we're going to pop the net profit at the top. Don't forget to turn it into a percentage. And this is what we're going to get. We're going to get 14.47%. Right, so those are the profitability ratios. Now let's move on to liquidity. So this is looking at the ability of the business to be able to settle its short-term liabilities with its current assets. So is the business able to pay for day-to-day operating expenses of the business and to keep the business trading? So there are two ratios here. One is the current ratio and the other one is the acid test ratio, also known as the quick ratio. So whereas your solvency ratio looks at all of the assets compared to all of the liabilities, the current only looks at your current assets to current liabilities. So what we need to do here is pop up again to the balance sheet, and we can find them there. Easy if you are given the balance sheet, because the balance sheet has got headings. Perhaps you may not have the headings on the balance sheet. So please don't forget what you've learned before in accounting. You must be able to recognize current assets and current liabilities. So let's see what we have got here. I'm just going to change the color. Our current assets for the period, they're in that light purple shade. Our current liabilities, just make sure we find the correct number. We've used it before, the 70,000. So all we're going to do then is a straight division. And what do we get? We have more current assets than current liabilities. So when we divide, we're going to find that our ratio is bigger than 1. Sorry, I just need to get up quickly because the gardeners put the edge cutter on. I won't be a second. Sorry about that. Okay, we're back. So the ratio of 2,73 is to 1. And just like I was saying before, what's going to be important here? This must be expressed as a ratio. Let me just remind you over here, this one must be a percentage. This one must be a percentage. And the gross profit percent must also be percentage. So all profitability ratios are percentages, whereas the liquidity ones will both be a ratio. Then, what is the difference between the acid test ratio and the current? So this will give us an indication as to whether the business relies too much on its inventory or not. So remember, we included inventory as one of the components of current assets. But the problem with the inventory is it doesn't necessarily mean that the business has collected the payment from those sales. So it could find that it's got lots of inventory causing its current assets to have a higher value, but no cash in the bank. So to see at a glance, is the business able to settle liabilities? We take out the inventory. So we're going to do that. Always make sure that you do write out the numbers as per the formula. So the current assets that we used above, and you must put in the value for the inventory. Subtract, And then the current liabilities is the same. Once again, we see that we have more on the current asset side than we do on the liabilities, but you see how the gap has narrowed quite a lot. The ratio now is only 1,27 is to 1. Note, of course, that it is a ratio. So there are these two ratios, they have a norm. So in your commenting, you may have to indicate whether something has improved year on year. Another option would be where you have to calculate the ratio for another industry or another firm. They could give you the industry average as well. But there are two ratios, and these are the two that have a norm. So for this one, for the current ratio, the generally accepted value, the norm, we're going to say is 2 is to 1. So how is our business doing compared to the generally accepted amount? Yeah, we are exceeding that. So we would say that the liquidity position of our business is actually very good, because for every R1 of current liabilities, it's got R2.73 of current assets. Your asset test ratio also has a norm, and this norm is 1 is to 1. So how is our business doing? Okay. We are slightly above that. So there's not an over-reliance on inventory. The business does have sufficient cash to settle its monthly current liabilities. Right, then we are on to the asset management ratios, and we are going to do 3. So first up is your average trade debtors collection period. So sometimes the question does not have the word average in it, but you will always use that, the average. So what are we looking at here? Trade debtors collection period. So this will be a period of time. So the answer must be days. Okay. Debtors relates to credit sales. So people to whom we have made sales on account. How long does it take for us to collect that money from the sales? So here is our formula. Average trade debtors. Remember, I told you to just watch that average. We need two values. And we relate it not to total sales, but credit sales. The difference in this ratio is this part here, the times 365, because that converts it into days. So all the values are available. So let's go and look at trade debtors. Remember, there are 2 or more ways of referring to that. They're also called trade receivables, or just debtors, or even accounts receivable. And we need the value for both years. So let me find it for you. So here are debtors for 2023. There are the debtors for 2022. So remember what we need to do with them. We need to add the two of them together and then do what to get the average? Divide by 2. Then if we are looking for credit sales, let's pop down here at the income statement. Over there, that sales is the value that we've used before in the GP and the NP percent. Right. However, that is total sales. It is not split into credit and cash. So how do we know what the credit sales are? We have to pop down to the information at the bottom, and here we can see it. In additional information number 1, it said credit sales was 75% of total sales in 2023. So what we need to do now is take the total sales number above, and we only need to find 75% of it. I just need to draw your attention to something very, very important here. We don't want any careless mistakes, please. What happens if you read this instead? if it said cash sales for 2023 was 25%, don't just look in the info and find a percent and it's sales and then you use it and then you make a silly mistake. We need for this ratio credit sales. So if it said cash sales 25%, you must remember to subtract that from 100% to get the credit sales of 75. But if they tell you the credit sales percentage, then you use that. So let's insert the values. Here, it will look like this. Let's get another color for a change. There, see here? The 0.75, which is the 75% of your total sales. Remembering that we did the averaging of the debtors at the top times the 365 gives me a certain number of days. So here you need to write down the answer that you see on your calculator, and then you can round it up to the nearest whole days. But the important thing is this. This one must be days. Right, now we're on to your average trade creditors settlement period. So what's this? Okay. We're going to take the average trade creditors and we're going to see how long our company takes to pay them, because that will affect our cash flow and our working capital. So as the name implies, average trade creditors at the top. Remember, they could also be called trade payables, accounts payable. Yeah, but it's easy to find because you have a balance sheet. So we're going to take the two values, which you can see at the bottom, add them, divide by 2. I don't think you need my help with that. But the important thing here is this. The credit purchases, NB, this one. So as we said, your debtors collection relates to credit sales. Your creditor settlement relates to credit purchases. As you know, you cannot find purchases on the income statement or balance sheet, let alone credit purchases. So you must consult the additional information because that will tell you what to do. And we can see over here. Here's where it is. Number 2, what does it say? Purchases was 80% of cost of sales, of which 60% was on credit. So what are we going to do? We're going to follow a bit of a procedure over here. We're going to go from cost of sales to purchases, and I mean there credit, total purchases, pardon me, and then we're going to go to credit purchases. So it's quite a story. Just make sure you get the steps correct. So we're going to use cost of sales as a proxy for purchases, but only a certain percentage of it. Once we've got total purchases, we then calculate credit purchases. So we're going to take our cost of sales, and have we got the number? Yes, we do. Remember, you're going to find it, second line on your income statement. So this is where it is. There's cost of sales in the green. Step 1, go and find 80% of that will give me purchases. And then final step, 60% again will give me credit purchases. So let me show you the workings. Here we are, this line. Do your other workings for average trade creditors. Don't forget times the 365. And then your final answer must be in terms of days. And you will take the 61.78 days and round it up to 62 days. Right. Not too many more to do in this particular worksheet. The last of the asset management ratios is your inventory turnover or average inventory turnover. Pay attention here to the formula for this one, because this one is slightly different. It has average inventory at the bottom, and it has cost of sales at the top. So spend more time trying to memorize this formula. Okay. And what this one is explaining is how many times in a year do we turn our stock over? So we buy in inventory, we sell it, we collect the money from the debtors, we use that money to buy more inventory, which we sell, collect, and so we have a cycle happening in the business. So how many times you are turning your stock over, average inventory turnover. So the important thing with this ratio is it's expressed as a number, which is times. So we're just going to take the cost of sales number. Remember to take the value for your two inventories. Where we're going to find it, obviously on the balance sheet. So where are the numbers? Over here. There's the inventory for 2023 in the green, and there's the value for the previous year. We're going to add as well, divide by 2. We're going to put cost of sales at the top, do your workings, and where we are down the bottom here, we're going to wrap up with 5,28 what? Times. Right. I'm going to ignore the inventory days. And what I did say that we're going to do instead is we're going to have a look at one of your gearing ratios, which is the debt equity ratio. Right. So I'm just going to now type it in here for you. So our debt equity ratio is a gearing ratio. And how does it work? As the name tells me, it's debt. And this is not credit card, and it's not trade creditors. It's debt as a form of raising capital for the business. So it's going to be your non-current liabilities, and we're going to divide that by our total equity. Right, so we need to look at the information. So let's come here. We're doing it for 2023. Our non-current liabilities, in this case, is just the mortgage loan. And where's our value? There. So that 278,000 is the non-current liability. What is the equity? We have looked at it before. The equity is up here, there. So we're going to divide the one by the other, and I'm just going to type in the values over here. Sorry, it is a bit of a nuisance setting up all the time. So we're going to say 278,996 is to the equity of 1,297,634. And then we are going to get our final answer. And this is 0,22 is to 1. And now let's have a look at it. It's a ratio. That's why it must be expressed in the format of a number is to 1. Now we see that we have a lot more equity than we have long-term debt. That's why our ratio is less than 1. In fact, it's quite small. So there's very little long-term debt here, which means that there's low gearing. If it was the other way around, if we had more debt than equity, it would be highly geared, and the number would be bigger than 1 is to 1. So there we have the end of quite a long recording. Hopefully you've understood now a lot about how to calculate various ratios. So I'm going to wrap up this recording and do a final one on investment ratios.